Imagine this. The world's most powerful economy, the United States, is quietly caught in a financial trap of its own making. Over the past 5 years, the cost of simply paying interest on America's debt has exploded, rising from around $500 billion to well over $1 trillion. Every single day, billions of dollars are spent not on schools, infrastructure, or healthcare, but just to service debt that already exists. And as interest rates climb, this burden grows heavier. It's a dangerous loop that economists have begun calling the debt doom loop. Here's how it works. When confidence in a nation's debt begins to slip, investors demand higher interest rates to compensate for the risk. Those higher interest rates make the debt harder to manage, which in turn erodes confidence even further. It's a vicious cycle, and once it begins, it can be almost impossible to stop. Now, the US government believes it may have found a way to break this loop. And surprisingly, the answer isn't traditional monetary policy or fiscal tightening. It's crypto. Yes, the same technology that many in Washington once dismissed as dangerous or speculative is now being eyed as the key to saving the dollar itself. Officials are calling it quietly a kind of crypto reset, a way to reinforce the global power of the US dollar in the digital age. But before we get to that plan, we need to understand just how deep this problem runs. The benchmark for government borrowing, the 10-year US Treasury yield, currently sits around 4.2%. That may not sound like much, but when you're dealing with trillions in debt, each percentage point means hundreds of billions more in annual interest payments. That rate is shaped by three forces: inflation expectations, the Federal Reserve's short-term policy rate, and something called the term premium, which is basically the level of trust investors have in the long-term stability of U.S. debt. Think of it as the confidence tax. When trust is high, the government can borrow cheaply. When trust fades, borrowing gets expensive very quickly. Right now, that term premium is hovering around 0.5%, well below the historical average of 2%. That's a sign that investors still have confidence, but it's a fragile kind of faith. If global trust in U.S. debt fell back to its long-term norm, yields could shoot from 4% to 6% or more, devastating budgets and possibly triggering a recession. Mortgage rates would climb, business loans would tighten, and the ripple effects would be felt in every corner of the economy. The last time the U.S. faced a crisis of confidence like this was during the 1970s, and back then, it ended in double-digit inflation and one of the worst recessions in history. Part of what has protected the U.S. for decades is the dollar's unique role as the world's reserve currency. Between 2000 and 2024, over 60% of all global reserves were held in dollars, but that dominance is beginning to erode. In early 2025, that number fell below 60% for the first time in a generation, a symbolic but worrying milestone. Major foreign holders like China and Japan, who once eagerly bought U.S. Treasuries, have become net sellers. That shift means the automatic demand for American debt, the built-in support that kept rates low, is fading. And this is where the crypto reset comes in. While foreign governments are stepping back, a new class of buyers has stepped in. Not countries, but digital issuers. The market for stablecoins, which are cryptocurrencies pegged one-to-one to the US dollar, has exploded to over $200 billion in circulation. Companies like Tether and Circle hold vast amounts of US Treasury bills to back each digital dollar they issue. In fact, together they now rank among the largest holders of short-term US debt in the world. Their demand for treasuries effectively creates a new stream of support for the dollar, one that doesn't depend on foreign central banks. In Washington, officials have taken notice. Earlier this year, new legislation was passed to create clearer rules for stablecoin issuers, aiming to make the market safer and more transparent. The idea is simple. If stablecoins can grow in a regulated way, the U.S. could reinforce global demand for its debt through a digital channel, maintaining dollar dominance even as traditional buyers retreat. Some analysts even predict the stablecoin market could reach $2 trillion within a few years. If that happens, stablecoin issuers could surpass both Japan and China as the largest holders of U.S. Treasuries. But let's pause for a second. If you're new to this channel, don't forget to subscribe and click the bell icon. We post deep dive stories like this every week, breaking down the biggest financial shifts shaping our future. You won't want to miss what's coming next. Now, while this plan sounds clever, it's far from a miracle cure. Even if stablecoins did reach $2 trillion in circulation, that's still just a fraction of the US government's $35 trillion debt pile. And while more digital demand might help stabilize short-term borrowing costs, it doesn't change the underlying math. Washington is still spending far more than it earns. If fiscal discipline doesn't return, the crypto reset could delay the pain, but not prevent it. And there's another risk. The very growth of crypto dollars could eventually weaken the government's control over the monetary system. If people and businesses worldwide start using digital dollars outside the banking system, the Federal Reserve could find it harder to manage liquidity and enforce policy. In other words, the tool designed to save the system could also make it more fragile. So where does that leave ordinary people like you and me? Well, while these high-level battles play out between governments, banks, and crypto firms, there are practical steps anyone can take to protect themselves. The first is to reduce exposure to high-interest debt. If interest rates rise, variable loans and credit cards will get painfully expensive. Next, build a cash safety net, an emergency fund that covers several months of expenses. Liquidity is security when markets turn volatile. And third, diversify your investments. Don't bet everything on one currency, one country, or one asset. A healthy portfolio in this environment includes a mix of equities with strong balance sheets, some exposure to inflation-protected bonds, and, for the more adventurous, a small, cautious allocation to digital assets. The truth is, the financial world is entering uncharted territory. The dollar isn't about to disappear, but it is evolving, forced to adapt to a digital future where power isn't just measured by central banks, but also by networks, protocols, and code. If the U.S. manages this transition carefully, by embracing innovation while maintaining discipline, it could extend its financial dominance for another century. But if it fails, the consequences could be historic. Higher interest rates, a weaker dollar, and a loss of trust that could take decades to rebuild. This story isn't just about governments or markets, it's about all of us. Because when confidence fades, it's everyday people who pay the price. The good news is that by understanding what's happening and preparing early, you can turn uncertainty into opportunity. And that's exactly what we aim to help you do here. If you enjoyed this video, make sure to give it a like, share it with a friend who follows the markets, and of course, don't forget to subscribe and hit that bell icon so you never miss an update. Because in a world where finance is changing faster than ever, staying informed is your greatest advantage. Thanks for watching, and see you in the next one.